Gold just did something it has never done in 50 years. It broke its own all-time record twice in 1 year, then lost a quarter of its value in 5 months. If you think gold is safe, you're about to see the numbers that prove you wrong. On January 28, 2026, gold hit an all-time high of $5,589 an ounce, gaining over $300 in a single trading session, the fastest run to a record in modern history. It didn't just beat the nominal 1980 peak of $850. Adjusted for 50 years of inflation, that old record works out to roughly $3,600 in today's dollars. January 2026 blew past that too, for the first time ever. Then came the Iran crisis. Escalating tension between the US and Iran, fears of a wider Middle East war, and fresh trade friction with China all hit gold's safe haven bid at once, right before the tension started cooling and profit-taking set in. By late June, gold had dropped roughly 25%, briefly dipping under $4,000. As of late July 2026, it's trading around $4,080, still up massively for the year, but a long way down from its January peak. That swing wasn't a glitch. That's what safe haven actually looks like in 2026. Here's the part most people skip. Gold produces nothing. No dividend, no interest payment, no earnings call, no rent check landing in your account every month. When you own a share of a company, you own a legal claim on future cash flow. When you own gold, you own a shiny, dense metal that somebody else has to want more badly than you do for you to make money on it. Its entire value rests on other people's willingness to pay more for it later. What economists sometimes call a greater fool asset, and what gold bulls call the one asset with zero counterparty risk, since it isn't anyone else's liability or promise. Both descriptions are true at the same time. That tension is the entire debate over owning gold. The pitch you've heard 1,000 times: gold protects you from inflation. Partly true, over very long stretches, 50-plus years, gold has roughly tracked inflation. But roughly tracked is doing a lot of work in that sentence. From 1971, when President Nixon closed the gold window and ended the dollar's convertibility to gold, through 2024, the U.S. stock market delivered average annual returns of 10.7%. Gold delivered 7.9%. That 2.5-point annual gap sounds small. Compounded over more than 50 years, it's the difference between a comfortable retirement and a merely adequate one on the same starting dollar. 2026 is the exception that gets all the headlines, not the historical rule. Gold bulls love to point to one specific decade, the 1970s. And they're not wrong too. Stagflation, high inflation paired with weak growth, devastated stock returns while gold soared roughly 20-fold from 1971 to 1980. It's the single best gold decade on record, and it's also the exception every gold pitch since then has been selling. The 1980s, 1990s, and most of the 2000s were nowhere close. Gold spent nearly 2 decades after 1980 going essentially nowhere, bottoming at $252 an ounce in 1999, a period bullion dealers do not put on their brochures. There's a boring economic variable that predicts gold better than almost any headline: the real interest rate, the return on safe assets like treasury bonds after subtracting inflation. Gold pays no yield, so every time the Federal Reserve pushes real rates up, holding gold gets more expensive in opportunity cost terms because you're giving up a competing, interest-paying safe asset for a rock that pays nothing. When real rates fall, or turn negative as they did during parts of 2020 and again in stretches of 2025 and 2026, that opportunity cost shrinks towards zero, and gold becomes relatively more attractive. Watch Fed policy, not gold headlines, if you actually want to see this move coming in advance. So why is gold ripping right now in a way it hasn't in decades? Follow the buyers, not the headlines. Central banks, China, India, Poland, Czechia, and several Middle Eastern nations have been net gold buyers for 4 straight years running. The trigger: in 2022, the US and its allies froze roughly $300 billion in Russian central bank dollar reserves after the invasion of Ukraine. Every other government watching that happen learned the same lesson simultaneously. Dollar reserves can be frozen by a policy decision overnight. Gold sitting in your own vault cannot. That's not a trading strategy. That's a structural, multi-decade shift in how nations hold reserves, and it's a floor under gold prices that simply did not exist before 2022. Here's the stat that separates this rally from every gold rally before it. In 2025, Global gold demand hit an all-time high of 2,175 tons bought through ETFs, bars, and coins that cheer up 84% year over year. And it wasn't jewelry buyers driving it. In the first quarter of 2026, jewelry demand actually fell 23% year over year, because it's the most price-sensitive part of the market. Meanwhile, bar and coin demand rose 42% to 473.6 tons. Pension funds, sovereign wealth funds, and family offices were building structural gold allocations that had been largely absent from institutional portfolios for decades. This wasn't retail panic buying at the corner coin shop. This was institutional money moving in serious size. Now here's what nobody puts in the highlight reel. Owning physical gold isn't free. And it isn't simple. A bank-safe deposit box runs $50 to $300 a year. And critically, banks generally do not insure what's inside it. A professional vault costs roughly 0.3% to 0.75% of your gold's value annually. On a $100,000 position, that's commonly $300 to $750 a year every single year, forever. Buy a coin from a dealer and you pay a premium over spot to cover minting and distribution. Sell it back, and the dealer buys below spot. That round-trip friction typically costs you 1% to 2% net, even after recovering most of what you originally paid. Keep it at home instead, and standard homeowners or renters insurance typically caps precious metals coverage at a few $100s. Nowhere near enough for a serious position, meaning you'll likely need a separate scheduled property rider, which is its own recurring premium on top of everything else. And if you're holding gold inside an IRA, storing it at home yourself is not optional. The IRS requires an IRS-approved depository. Home storage of IRA gold triggers a taxable distribution and penalties. No exceptions. There's a risk in owning physical gold that has nothing to do with price at all: fraud. Counterfeit gold bars and coins are a real documented problem. Sophisticated fakes have shown up with tungsten cores that match gold's density almost exactly, passing casual weight checks that most buyers actually perform. Even legitimate-looking coin shops have, in isolated but well-publicized cases, sold clients bars that later failed independent assay testing. The protection against this is straightforward, but not free. Buy only from dealers accredited by industry bodies like the LBMA or through major established mints, insist on serialized bars with assay certificates, and for any position over a few $1,000s, get an independent ultrasound or XRF assay before finalizing a private party purchase. That verification itself typically costs $50 to a few $100s per test. Online marketplaces and classified ad private sales carry meaningfully higher fraud risk than an accredited dealer, precisely because there's no reputation on the line and often no easy recourse once the money has changed hands. This isn't a reason to avoid physical gold. It's a reason to budget for verification the same way you'd budget for storage, as a real recurring cost of doing this safely, not an optional afterthought for the paranoid. So investors flock to gold ETFs instead. Simpler, more liquid, no vault required. But you're trading one cost structure for another, not eliminating cost. GLD, the largest gold ETF with over $132 billion in assets, charges a 0.40% annual expense ratio, deducted automatically by quietly selling off small slices of the fund's actual gold bars. Competitors like IAU charge 0.25%, and AAAU charges just 0.18%. That fee gap compounds over time. Over the last 10 years, GLD returned 189.44%, while IAU, same underlying gold, lower fee, returned 193.49%. And critically, with a standard ETF, you don't own gold. You own a claim on gold, redeemable for physical metal only if you're an institution trading in multi-million-dollar blocks. There's a third door most beginners never consider: gold mining stocks. A miner's profit isn't just the gold price. It's the gold price minus their cost to dig it out of the ground, which means mining stocks act like a leveraged bet on gold itself. When gold rises, miner profits can rise even faster. When gold falls, the same leverage cuts the other way, hard. Miners also carry all the normal risks of owning a business: bad management, mine accidents, rising labor and energy costs, and country risk if operations sit in politically unstable regions. You're no longer just betting on gold, you're betting on a company that happens to sell it. Between owning the metal directly and owning a mining company sits a hybrid. Nobody puts on beginner lists. Gold streaming and royalty companies. These companies don't dig anything out of the ground themselves. Instead, they pay a mining company cash up front for the right to buy a fixed percentage of that mine's future gold production at a steep discount to spot price, sometimes a few $100s an ounce below whatever gold is trading at years down the road. In exchange, the mining company gets capital without taking on debt or diluting shareholders. The appeal for investors is a genuinely different risk profile than owning a miner outright. Streaming companies don't operate the mines, so they're insulated from rising labor costs, energy costs, and a lot of the operational risk that hits a mining company's margins directly. They still carry gold price leverage similar to a miner, but without needing to manage a single actual mine. The trade-off is concentration and counterparty risk of a different kind. A streaming company's fortunes depend on a relatively small number of contracts with a relatively small number of mining partners. And if one of those mines underperforms or shuts down early, that specific revenue stream disappears regardless of what gold itself is doing that year. This is the one that catches almost every American investor off guard. The IRS classifies gold, physical bars, coins, and even gold ETFs like GLD and IAU as a collectible. Long-term capital gains on collectibles are capped at 28% federally. Stocks and most other assets max out at 20%. On a $50,000 long-term gain, that difference alone is $4,000 to $6,000 in extra tax owed. Stack a 3.8% net investment income tax on top if you're a higher earner, add your state's rate, and you can lose over 40% of your gain to taxes combined. Picture two investors who each turn a $100,000 stake into $150,000 in long-term gains. The stock investor pays at most $30,000 in federal tax. The gold investor in the top bracket pays up to $42,000 on the exact same dollar profit, a $12,000 gap on identical returns purely because of what the asset happened to be. The one major exception, gold held inside a properly structured IRA skips the collectibles rate entirely and follows normal retirement account rules instead, taxed as ordinary income on withdrawal or tax-free in a Roth. Safe haven is a marketing phrase, not a statistical description. During the 2026 US-Iran crisis, gold's realized volatility spiked above 50%. It has since cooled to below 30%, but that's still nearly double gold's own 20-year average volatility of 17%. A metal that swings 25% in 5 months is many things. Boring isn't one of them. Compare that to an actual low-volatility asset like a savings account or a short-term treasury bill. Gold is a hedge against certain specific risks. It is not a hedge against price swings in gold itself. Let's be fair to gold for a second, because the last 5 years genuinely favor it. Over the trailing 5 years through mid-2026, gold returned 125.65%, more than double the S&P 500's 67.79% over the same stretch, using SPY as the benchmark. But zoom out to the full 53 years since 1971, and stocks still win on average by nearly 3 percentage points a year, a gap that, compounded, dwarfs any 5-year window. Gold had an incredible recent run. It has also historically had decade-long stretches of doing almost nothing at all. Put it in real dollars, $10,000 invested in the S&P 500 in 1971, and left alone would be worth vastly more today than the same $10,000 parked in gold, even counting gold's spectacular 2025 and 2026. Gold wins specific stretches decisively. Stocks win the marathon. Recency bias is the most expensive bias in investing, and gold's 2026 headlines are prime recency bias fuel. Gold isn't the only asset pitching itself as insurance against the dollar anymore. Bitcoin has spent the last several years positioning itself as digital gold, a fixed-supply, non-sovereign store of value that a growing number of younger investors now prefer outright over bullion. Some corporate treasuries, and even a handful of state-level pension discussions have floated Bitcoin allocations for the exact same reasons central banks buy gold: diversification away from a single currency system. Whether that thesis actually holds up long-term is a separate video entirely, but it matters here for one reason. Gold no longer has a monopoly on the "protect me from currency debasement" pitch, and that competition for capital among younger, digitally native investors is genuinely new. So what's the actual answer? Not the hype, not the doom. Most portfolio strategists who like gold at all suggest a 5% to 10% allocation, not a core holding. At that size, gold smooths out portfolio volatility during equity crashes without dragging down your long-run growth. Because remember, it produces no income and has historically underperformed stocks over multi-decade horizons. On a $200,000 portfolio, that 5% to 10% band works out to $10,000 to $20,000 in gold exposure. Enough to matter during a genuine equity crash, small enough that a 25% gold drawdown, like the one investors just lived through between January and June of 2026, doesn't wreck your overall plan. Go meaningfully bigger than that, and you're not hedging anymore. You're making a concentrated, directional bet on a non-yielding asset, which can be a legitimate strategy, but it's speculation, not insurance, and it should be sized like speculation. Wall Street's 2026 forecasts are aggressive. JP Morgan has pointed towards $6,000 plus by year-end. Deutsche Bank and Societe Generale both see $6,000. UBS has floated $6,200. Every one of those numbers assumes three things happen together. Central bank buying continues, real interest rates keep falling, and the dollar keeps weakening. That's three separate bets stacked on top of each other. If even one goes the other way, the Fed holds rates higher for longer or the dollar unexpectedly strengthens, those targets get a lot harder to hit. And gold's own 2026 chart already showed you exactly how fast it can give back gains once sentiment turns. So which is it? Gold is neither the salvation your uncle's gold bug newsletter promises, nor the dead asset that stock-only purists dismiss outright. It's a real hedge against a specific narrow set of risks: currency debasement, geopolitical shocks, and the central bank policy mistakes, priced at a real and often invisible cost. Zero yield, genuine storage friction, and a 28% federal tax rate most American owners never see coming until the bill actually arrives. It's insurance. Good insurance is worth paying for. Nobody builds their entire retirement plan out of insurance premiums. The real question was never simply gold or no gold. It's whether you understand exactly what you're buying: an inflation hedge, a geopolitical insurance policy, or a speculative trade dressed up as safety, before you actually wire the money. If this changed how you think about gold in your own portfolio, tell me in the comments. I read every one. And if you want the same breakdown on Bitcoin as digital gold, subscribe.